Hello, good evening, everyone, and a happy new year. Welcome to our first Market Outlook webinar for 2026. Hope everyone is healthy and sitting comfortably. All right, as usual, today I will take you through our webinar. As you can see, the title is enough to whet your appetite. The rise of Asia. Ooh, terror near. Okay. Hopefully by the end of this webinar, you guys can feel a bit more confident. Okay. Okay. As usual, for today's webinar, I'll be further supported by Pak Leng, whereby he will take you through the sector update. Hi, Pak Leng.
Hello, everyone. Hi.
And after which, Crystal will appear to take you through our stock pick for Malaysia, Hong Kong, and US. Hi, Crystal.
Hi, Kenny. Hi, Pak Ling. Hi, everyone.
Okay. Without much further ado, okay, let me take you through the market outlook and what we are expecting. Okay, at least for the first two quarters of this year. Okay, let's start. See you guys later. Next, please. Okay, I think all of us know that we cannot talk about the market without mentioning Trump. I think he loves being mentioned. That fella. Okay, I think for this year, I think it is apparent that Trump has decided to carry his so-called policies well into 2026. All right. I think, in fact, he is fast-tracking the US into both financial and political obscurity. I think this one we all know. All right. I mean, in the sense, right? I mean, despite the Wall Street continue to chart all-time high, I think we're also seeing global funds. I think maybe those are non-US global funds continuing to relinquish their holdings in US denominated assets. I think that one is quite evident of late. All right. So I think for this year, we're also seeing possibly a lower interest rate environment, which should be conducive for both businesses and equities alike. Okay, back to Malaysia. I think for 2025, there's been some, I'll say, refining of earnings. I think has been slightly downgraded to 1.3% for this for 2025 from 2.1% before. Okay, for this year, things are looking more cheerful. We are expecting earnings growth to trend around 7.1%. Okay, upgraded from 6.2% previously. I think this is due to the broad-based, improvement. Okay, especially for both the banks and the planters. Next, please. Okay, let's talk about US first. All right, I think all of us know, so far Trump has single-handedly transformed. This is what I noticed, belief into denial. That's for the economy. All right, confidence into hesitation. That's for the finance. All right, as we saw in Wall Street of late. And certainly, out of chaos, that's politics. I think politically, he is he's a disruptor. Okay, never mind that. Okay, let's go back to BRICS. I think I just want to do a bit of recap on BRICS. I think BRICS has been steadily growing its presence, not in terms of members, but in terms of their, by allowing the members to conduct their business in their own currencies. Okay. To recap the story so far for BRICS, I think full members are still at 11. All right. Partner countries around 10, which includes Malaysia. All right. Currently, BRICS accounts for more than 40% of the world population, and also approximately around 30% of global GDP. All right. We all know that all these countries are rich in and diverse in raw materials, and at the moment, I think the BRIC members controls almost 45% of global crude oil production and reserves. Okay, and most importantly, that I say this now, is the rollout of BRICS Pay. Okay, this allows the trading nation to use their own currencies instead of the USD and also SWIFT, which the West like to use it as a weapon or sanctions, to those countries that they dislike. Next, please. Okay, I think so far we are seeing Trump's tariffs are backfiring, to say the least. I think as you can see, economy not doing that well. I think the U.S. job environment is also cooling. From the latest job data. So I think although many experts are viewing this as a solid excuse for more rate cuts by the Fed, okay, now on the flip side, the Fed has got a major headache. That is the 38.6 trillion USD national debt, okay, that the US is shouldering at the moment. Okay, I mean, if you reduce interest rates, how is the Fed going to finance this debt? Or whether they can entice new takers or demand for the new issuance of US treasuries. And also very funny that Wall Street has been ignoring this huge headache, was a major headwind, so for them to climb to record high over the last few sessions, so as we all know that, as I mentioned just now, the US is certainly losing its global financial dominance. All right, so hence it is inevitable that the USD will weaken further. All right, hence intensifying the risk of holding US denominated assets. Next, please. Okay, this chart, I think I've shown it before previously, okay, and I want to show it again. As you can see that, for 2015, the top 10 holders of US bonds, as compared to 2025 has changed dramatically. Okay, 10 years ago, I think 10 years ago, I think you can see that the lists are more diverse, with the emergence of Hong Kong and Taiwan, things like that. For recently, you can see these two countries together with Brazil and Switzerland, nowhere to be seen as the top 10 holders of US Treasury. But having said that, I think China has also gone down the top 10 list from 1 to 3rd. I think 10 years ago, China is holding almost 1.3 trillion of US debts. Now they have certainly, been dumping their holdings. Now it's just marginally less than 700 billion USD. As I mentioned just now, I mean, with the absence of Chinese demand, how is the Federal Reserve or the US going to finance their huge national debt and their interest payment that could be in excess of 1 trillion USD per year? Well, food for thought. Okay, next, please. Okay, this chart just show that how dramatic the dumping by China on the US bonds since 2015. Since 10 years ago. From 1.3 trillion USD to currently 688 billion. So I think with that, right, I don't think China is stopping anytime soon. I think the dumping should continue. As we all know, China has been dumping the US treasuries and going big into gold. Next, please. Okay. As I mentioned now, there's definitely a denial on Wall Street, And here's our radical perspective on the market cap of the so-called Mac 7 in comparison to the GDP of some top Western countries. All right, you can see that some of these, or most of this market cap of this Mac 7 has outshined, okay, the GDP of most of the EU countries or the Western countries, which I think is rather irrational. All right, I mean, so I mean, it goes to say that the current state on Wall Street is certainly being blown up, by the excess of liquidity within the financial system via the QE. All right. Next, please. All right. As the Wall Street has been charting all-time high. All right. I think the rich are getting richer, so there's a rise of the oligarchs. All right. I mean, that's rather apparent. This is happening in the US. I think this chart shows that for the top 1%, right, they are holding more than 50% of share of corporate equities and mutual funds in the US. For the top 1%, would you believe that? Next, please. And as for the deprived, I put here no IC. The bottom 50% is holding less than 1.5% of the similar assets. That's why I think over the past 10, 15 years, I think America, they have shot themselves in the foot by the destruction of all this the middle income segment, which has been the engine of growth for the US all this while. So so Trump cannot blame anybody but themselves. All right. Next, please. Okay, moving over to Hong Kong. I think Hong Kong is still yummy. All right. I think there's still a huge appetite for Hong Kong equities. I think last year Hong Kong made a very strong comeback with a gain of 31% of its the Hang Seng Index. All right. But having said that, despite the valuation is now at par to their historical average, I think we still view that there's still leaks for the Hang Seng Index to climb further, because at the moment Hang Seng Index is probably trading at around 12 to 13 times PE, at par to their average, historical average. But there are certain instances, right, the Hang Seng Index has trended above the 25 times PE. All right. I think this is largely due to the influx of liquidity back into the market, which we are seeing at the moment. So not surprised at all if the Hang Seng Index breaks the possibly breaks the 28,000 level anytime soon. All right. I think basically, I think foreign funds are definitely looking into Hong Kong. I think they've really changed their tune. They are very much positive on both the China and Hong Kong equities. All right. I think the strengthening currencies recently of China, the renminbi, I think from 7.3, 7.4 to now about 6.9. I think that also has been a positive catalyst for the Chinese related market. All right. I think focus will also be from the recent China's 15 5-year plan. All right. This year until 2030 to kickstart economic growth. All right. And again, many expect more cuts in the triple R. All right. And also the interest rates. I think this aggressive easing policies in China are bearing fruits, which I will show you in the next slide. All right. I think interestingly, I think the PBOC, the Central Bank of China, is also now more proactive, okay, and also getting more flexible. All right, in adjusting their monetary policies to pump up the economy. All right. So next, please. As I mentioned, I think Beijing, I think last year there's already unveiled a lot of measures. I think 50 basis point cut in triple R, or the reserve requirement ratio, and also which has reduced this triple R to 6.2% from 6.6%, showing there's still ample room, okay, for more cuts. All right. So I think again, I've mentioned this one a lot of times. For every 25 basis point cut, this will add about USD 70 billion into the financial system. All right. So meaning to say that I think the Chinese government is quite aggressive, all right, to instill market confidence and faith, especially within the property segment, and also to improve the domestic demand. All right. Next, please. As I mentioned just now, I think from the easing policies, this has certainly have a positive impact on the Chinese market. You can see the divergence between 10-year yield, the Chinese 10-year yield, and also the Shanghai Composite Index, recently. So this is a really encouraging gap, from the divergence. All right. Next, please. All right. In the US, they have got a Max 7. I think this one we have mentioned before. All right. What we've coined here is we have 10 Chinese stock, which we name possibly Terra 10 or T10, with a list of tech companies. All right, as you can see that, I think valuation wise, still reasonable, okay, unlike those on a Nasdaq. All right, next, please. Okay, in terms of valuations between Wall Street and Hang Seng Index.
Yeah, remember my shares.
Okay, hang on. Sorry. Sorry for the technical hitch. Okay, in terms of the valuation between Wall Street and Hang Seng Index, you can still see that, I think those on in the Hang Seng Index, right, is still way below those on Wall Street, and despite still trading at par to the historical average. But if you look at those on Wall Street, right, certainly they have easily double in terms of valuation, okay, for all three major indices. All right, next, please. Okay, let's go back to the local boss, and next, please, and see what's the latest. Okay, I think for the FMKLCI and also the rest of the index, right, I think also within a region. All right, in terms of PE, it is still trading below their respective historical averages. All right. So I think certainly countries and within the Southeast Asia region, right, still offer decent value proposition for foreign fund managers. All right, I think all of us are trading within a very decent or reasonable PE. Okay, yeah, next, please. Okay, so fund flows, this one has been quite a disaster for Malaysia over the last 3 years. I think after seeing some massive outflow in 2023 and 2024, I think personally I was hoping that 2025 would perform even better, but no, it performed even worse. 2025 we actually saw 22.6 billion of net outflows. Holy, oh man. So that's why, but that did not translate into the performance of the index. So for that, we have to praise our local institution in supporting and even prop up the index. I think rather than being just trashed down by the foreign funds. Okay, so I think for this year definitely we are expecting a better better showing in terms of fund flows from the foreign side. I think already over the last few days we are seeing trickling of foreign funds back into the local bourse. All right, not much. I think possibly around a few 100 million here and there. I think hopefully this will be a good start for 2026 and the rest of the year. All right, next please. Okay, as for the foreign shareholding, I think it's still at around the 19% level. All right, I think those already want to be entrenched in the local market. It's already here. I think those are the longer term foreign funds. As I mentioned previously, also I think those in and out over the short term, those are the day trippers. I mean, what I tell also like Singaporean go to Johor, buy stuff and go back, day trippers. All right, but looking forward, hopefully the foreign shareholding for the local equities would enhance to maybe hopefully to above the 25%, closer to 30%. That would be a decent percentage. All right, so from 19% now, hopefully things would look better then. Okay, next please. Okay, retail participation or the lack of it. I think it is also apparent that the retail investors are still sidelined. Okay, I think basically due to the lack of catalyst within the local market, right? Nonetheless, going back to September last year, we noticed there are some activities within the small cap space, whereby the FPM small cap index was trying to do a mini rally, but that didn't actually it wasn't successful due to the lack of follow through buying. I think it lasted only for a month or so. But having said that, right, I always believe that to have a sustainable run in the small cap, I think the market needs to see an overall improvement in liquidity first, and that usually starts from the blue chips. That's what we are seeing now. That's why what I'm saying is that maybe the current setup whereby index has been on the uptrend, that should also be quite conducive and entice retail participation to come in soon. All right. Next please. Okay, rise of Asia. Again, I'm showing this table in terms of foreign reserves, okay, for the top 10 in Asia and against those over in the West. All right. In this slide, I've also added the foreign reserves, in 1999. That is just after the Asian financial crisis. Okay. If you look at the one in China, when I did this, I was shocked when I saw the Chinese foreign reserves of only 155 billion. And fast forward 20 years later, or 25 years later, this foreign reserves has gone by from 155 billion to 3.4 trillion USD. I think same goes to Japan, India. I think you see the list, all of us have performed or have been performing very well. I think in terms of Malaysia, look at Malaysia right after the Asian financial crisis, our foreign reserves was only 30 billion USD, and now it's 125. So it shows that I think Asian countries, right, has been slowly doing their own business, in accumulating foreign reserves to have a more solid and steady fundamentals. All right, and based on the latest foreign reserves of the top 10 vis-a-vis the Western countries, over here 7.8 trillion USD, over there only 3 trillion. Despite saying that despite the usual connotation saying that the West are richer, right? You look at in terms of foreign reserves, I don't think so. Next please. So like as mentioned so now, haven't understood the Asian financial crisis, which nearly drowned, this region. So Asia now is on a very solid foundation. I mean, you look at the burgeoning foreign reserves among the top 10, right? It has actually jumped by 9-folds, accounting for 60% of global foreign reserves, currently totaling at about 13 trillion USD. All right. Again, as I mentioned, money attracts money. If this is true, right, then Asia is in for more excitement. I think already we are seeing such happening, okay, or developments within the China and Hong Kong market, right? So hopefully this will cascade down to Southeast Asia anytime soon. All right. Next, please. Okay, as for the Southeast Asia market, I think it's been a stop-start situation for most of the Southeast Asian countries. Okay, but most of us are probably there's a slight gain or flat, something like that. All right, but I'm confident that once the party between China and Hong Kong dissipates, I think more funds would cascade down to this region. I think therefore we have tweaked our FBM share target for this year to 1810. All right, premise on 17 times PE. All right, from 1730 before. All right, and as for the ringgit, I think USD, I think the recent strengthening of the ringgit is no fluke actually. I think we believe it could even break the four ringgit level, all right, anytime soon as well. And this should also act as a pivotal catalyst for equities. Going forward for this year, we're expecting the ringgit to trend between the 380 to 4 range, okay, against the USD. I think in the US, that Trump is also hell bent on lower interest rate environment. You see, I think why Trump has been so aggressive on the Federal Reserve to reduce interest rate. I think there's only one clear reason, one main reason, because he realized that his tariff is not working. His tariff is actually backfiring on him, making things in the US more expensive, hence inflation. So by reducing interest rate, right, the impact will be more immediate. I think all the especially the middle income, all right, will have some breathing space with the lower financial costs. All right, but this is only a short-term remedy. Long-term wise, I think the US is in for a lot of problem. Okay. Next, please. Okay, just show you that the current status of all the major markets in Asia. All right, you see that. I think Hong Kong. You see that after 31% gain, I think there are some consolidation year to date for this year. But I'm sure they are poised for a year of the horse rally in Hong Kong. I think all eyes on Hong Kong Chinese market as well. I think as for the South Asia, I'm very confident, about the local market as well for Malaysia. I think apart from Vietnam, I think the rest of the market, some of the countries also being besetted by some political upheaval, like in Thailand, the Philippines, in a way also Indonesia. So I think Malaysia by default, with the current steady political environment, that should be very, very conducive, for foreign funds to come in a even bigger scale, right? Next, please. Okay, I think that's all from me, and I'll pass the floor to Pak Leng. Over to you, Pak Leng. Thank you.
Thank you, Kenny. Okay, we will continue with the sector updates. Next, please. The auto sector, we project total industry volume, TIV, of 725,000 units for 2026. This is actually 7% lower than our initial projection. This is mainly due to softening consumer sentiment and also inflationary pressures. And also vehicle prices could be potentially higher due to the implementation of an open market value excise assessment, and which could also push the local CKD cars higher. And at the moment, there are not much upside on the stocks. Therefore, we don't have any pick for the sector. Banks remain our favorite, one of our favorite, given their strong fundamentals and also dividend yields. In the latest financial results in third quarter 25, they recorded very solid earnings. And for the sector for this year, right? Sector earnings are expected to remain resilient, with a loan growth of projection of 5%, around 5%, supported by a stable OPR at 2.75%, and a net interest margin will be steady at around 2%. We like MBank, CIMB, and RHB. Next is a construction sector. The outlook remains favorable. I think this because there are many projects still not announced. That meaning, therefore, there is a lot of potential in the sector, and the sector will be underpinned by a growth in the private, such as data centers, logistics, and also high-tech manufacturing, as well as government projects such as infrastructure under the 13 Malaysian plan, with an allocation estimated at about 430 billion ringgit. Key projects are for 2026 will include Penang LRT, Trans Borneo Railway, Sungai Klang Link, JB, elevated autonomous rapid transit, and also Penang water transfer project. We have several topics here: Gamuda, Suncon, Kajaya Prospect, and also Intabena. Next. Okay, consumer, we are overweight due to several factors. First is, I think, the production cost has lowered slightly as compared to previous year, and the stronger ringgit against USD will reduce import costs, hence, and also a resilient spending on essential goods. Therefore, also improving tourism-related spending ahead of a Visit Malaysia year 2026. The recent quarter earnings has also seen a margin improvement on the sector. We favor Mr. DIY, FNN, and Spritzer. Glove. We are neutral on the glove, despite some improvement, but the pace of the improvement is actually not as quick as we expected. Therefore, this is also the oversupply issue remains there. We think the recover, I think the oversupply issue thing will maybe could recover by end of this year, hopefully. But one of the good things is the falling prices of the raw material, which is nitrile and latex, will definitely improve the cost of production. And but at the moment, we do not have any picks for the sector. All right. Next is oil and gas. We are also neutral on oil and gas, as the crude oil price remains below $70 per barrel, and which may have a constraint to the sector's growth outlook. Petronas capex is estimated to be around 50 to 55 billion this year, ensuring supply security and sustaining production targets. OPEC Plus has signaled a pause and also lower the production in the first quarter 26 on the crude hopefully to get a better crude oil prices. Yeah, and given the limited upside of oil and gas sector, we are neutral. Yeah, but we see we Armada and also Dialog as quite a good value buying. Yeah. Next. Okay, Plantation, we are still neutral. The direction of the CPO is still uncertain. CPO price is currently hovering around 4,000 ringgit per metric ton, as compared to about 4,003 in the last year. Yeah, and this I think at the moment it doesn't look attractive, but we like planters with good dividend yield, such as Taan. It provides a yield of around about 6 to 7%. Having said that, if the CPO price breaks 4,500 ringgit per ton, there could be a opportunity in trading of plantation stocks. For power utilities and renewable energy sector, we are overweight, and the sector is also benefiting from the surge in a new data center development, which will drive the electricity demand higher, along with the government ambitious target of achieving 70% renewable energy capacity by 2050, from currently at 25%. And the government also expect the demand for data center demand to reach 12.9 gigabyte by 2030. We are positive on the sector, and with topics of on Tenaga, YTL Power, Malakoff, Samaiden, and SolarVest. Property sector, we are still neutral. We see the price below 500,000 developers, which price the selling price below 500,000 will see a healthy demand. But also the industrial property segment is also supported by e-commerce growth, which and also government-driven initiatives. We maintain a positive stance on Sime Prop due to its diversified portfolio, and they have quite a number. They have residential and also commercial properties development. Marsing, they're quite flexible in the business model, while Sunrise is expected to benefit from the completion of Johor Singapore Rapid Transit LTS link. Next, please. Okay, REIT, the outlook remains promising, but there is no wow factor for the REIT sector because everything remains stable and single-digit growth. We are neutral on the REITs sector at the moment. However, we favor Sunway REIT and Pavilion REIT given the performance on retail REIT are better than average. Okay, next is technology. We are also neutral. The global AI spending is forecast to exceed $2 trillion US dollar in 2026, which is up 500, which is 500 billion more than 2025, 1.5 trillion. And our government is allocating 1.636 billion ringgit to the Ministry of Digital in budget 2026 to accelerate Malaysia's transformation into a regional AI hub. For semicon, I think the demand remains quite good especially in the wafer fabrication and also advanced packaging. And the outsourced semicon assembly and test is also one of the beneficiary in the global tech upcycle. Sector topic is Inari, Kellington, SKP Resources, and VS Tax. Move to the telco. We are neutral on the telco sector. The dual network 5G rollout is expected to continue in 2026, with operator targeting 80% population coverage by second half of this year, supporting by higher value mobile data and in IoT usage. Given the growth in data services and enterprise solution and IoT, together with a cloud connectivity, is expected to offset the slower growth in the old voice and legacy services. The rise in fixed broadband and the demand is increasing in the fiber optics. Will expect to drive the sector to grow higher. Yeah, we like Celcom DG for its potential upside, while Time.com and Maxis for their dividend yields. Okay, next. Okay, I pass it to Crystal. Over to you, Crystal.
All right. Thank you, Leng, for the sector update, and also Kenny for the brief overall market outlook. So, hi everyone. Hi Eric and William. Thanks for joining us tonight. Glad to see you guys again this year. So, I hope you guys are still with us because we are finally getting into stock picks, which I know many of you have been waiting for. So today I'll be walking you through 20 stock picks. Yeah, it's is a lot. So bear with me. I'll keep it short and simple for you guys. And the session will split into 4 parts, starting with the blue chips and also gems and Hong Kong and US stock pick. So without further ado, let's start with the first blue chip stock. Okay, first one we have MBank. So MBank is an outperformer since second half last year, both technically and fundamentally. So in first half FY25, it delivered 1.05 billion in net profit, meeting expectations, and is growing earnings at around 7%, faster than the industry average of about 4%. So more importantly, the margins are holding up, with management guiding net interest margins to stay slightly above FY25's 1.97% despite the industry headwinds. And the dividend yield is about 5.4%, which is 31.5 And the target price given is 6 ringgit and 90 based on the PBV of 1.02 times, reflects steady earnings delivery with potential upside surprises. Next, we have Gamuda. Next slide, please. Okay, so for Gamuda, it recently secured a 497 million Australian dollar of project in Australia, of course, spanning 5 years, while the outstanding order book stands at 39.8 billion ringgit, with a clear path to reach their target of 50 billion by end of 2026. So the strength here is the earnings visibility, which already secured through projects across Australia, data centers, and also railway. So the target price for Gamuda is set at 6 ringgit 13 based on the sum of parts valuation of PE of 22 times, reflecting the Gamuda execution strength rather than cyclical optimism. Next up, we have Mr. DIY. Okay, so the group has planned to open 155 new outlets in 2026. Its My Case network is also expanding from 125 to 300 stores by early 2026. So this is well positioned for their 100 ringgit Sara cash aid rollout. And the target price set is 1 ringgit 80 based on a 24 times PE, reflects a stable expansion backed by scale and efficiency. Followed by PPB Group. Next slide. Okay, so PPB core net profit for the 9-month result came in at 968.6 million ringgit, up by 18% year on year. So while the trading income can be quite volatile and the flour demand is also remain resilient, margins benefit from the softer wheat prices and property earnings are expected to improve into FY26. So the investor also enjoy a dividend yield of about 4.1%. And the target price given is at 12.50 based on a 16 time PE, and also applying a discount of 35% due to its holding company status and also their WIL legal cases. And the last for the blue chips, we have the energy backbone, Tenaga Nasional. So Tenaga growth narrative is increasingly tied to data centers. Around 700 megawatt of data center capacity is expected to come on stream this year, so driving the incremental electricity demand. And on the regulatory front, the investment allowance approval will help offset the future tax expenses, so it will offset against the future taxable income. So the target price for Tenaga Nasional is set at 16 ringgit 80, reflects a long-term cash flow stability and also exposure to the digital infrastructure growth. Done with the blue chips, now have a look at my gems on the small mid-cap stocks. First, we have CBH Engineering. So CBH is a direct beneficiary of the Johor data center expansion. So it secured 130 million worth of substation job recently, where the FY25 year-to-date job wins has reached a record of 601 million ringgit. And the outstanding order book currently stands at 681.2 million, providing a strong earnings visibility for the next 2 years. And target price set at 64 based on 20 times PE on the FY26 EPS. As the earnings continue to surprise on the upside, we see more room for a valuation re-rating, which could lead to a higher target price. Okay, next on EG Industries. So EG Industries sits within AI hardware supply chain. So we expect margin improvement as it ramps up the higher value 800G of optical modules, with the mass production targeted in 2026, followed by the 1.6T modules by first half of 2027. So additionally, customer has already been secured with revenue contribution expected from mid-2026 with a target price of 1 ringgit 90 based on a PE of 16 times. Next, we have Inta Binar. So Inta Binar offers a strong earnings visibility with a strong job wins worth of 866 million. and also unbilled order book of 1.5 billion ringgit, covering earnings for the next 2 to 3 years. So the company is also expanding downstream into lifts and escalator maintenance, adding to their recurring income. So the dividend yields is about 6% and 6.7% for FY25 and FY26. Target price set at 99 cents based on a PE of 13 times. Alright, followed by the next one, IT Max. So IT Max secured a 42 million DBKL contract for the smart traffic lights and generating about 14 million revenue in a year with margins of 40 to 45%. So also their 5,000 unit of CCTV project is expected to contribute around 60 million revenue once fully operational. So with that, our target price is given at 5 ringgit and 74 cents, reflects on the long-term municipal contracts with strong profitability. Okay, and last for Malaysia stock, we have Uzma. So Uzma combines energy services with renewables. Its Yasmis vessel is operating at about 95% utilization, supporting their near-term cash flow, as the vessel is operate in a day rate basis, so providing a strong cash flow. And also for LSS5 Solar EPCC new project position a renewable segment to contribute about 90 to 100 million ringgit in FY26. So with that, we have a target price of 1 ringgit, reflects the improved earnings quality and energy transition exposure. Now, let's have a look at our Hong Kong dim sum favorite. Okay, first we have Alibaba. So Alibaba is showing tangible AI monetization. Their cloud revenue has grew quite strongly year on year of 34%, driven by adoption of its Q1 large language model, and with a regulatory pressure easing and also cloud growth re-accelerating, sentiment is turning and consensus target price currently stands at 194.67 Hong Kong dollar with a 98% buy call. So looking at technical, the stock has gapped up and broke out from its 2-month pullback. So we see this as a signal for trend reversal and gathering momentum for next leg higher. Next, we have Bank of China. So Bank of China benefits from the China potential easing cycle and also digital yuan expansion. The commercial banks are now required to pay interest on the digital yuan balances, increasing the wallet usage and transaction activity. So combined with the potential rate cut and also the balance sheet growth, the consensus target price is now at $5.48 with a 22% upside and 96% buy call. Looking at the chart, the stock has broken out from its bullish flag pattern a few sessions ago after a healthy correction signaling a firm rebound and a potential trend reversal in the near term. And then we have the next one on China Mobile. So China Mobile operates the world's largest 5G network and continues to generate strong cash flow. So it offers an attractive dividend yield of around 6.5%, payout ratio near 75%. So its acquisition on the HKBN will strengthen their enterprise and also their fixed line exposure. So the target price is at 103.93 with a 30% upside and 96% buy call. Looking at the chart, we see that despite a strong pullback, the long-term uptrend still remains intact as long as the stock holds above its key support at 77 Hong Kong dollar, also a potential accumulation zone. And then we have JD.com. So JD.com is unlocking value beyond e-commerce, and it is also acquiring Seasonomy in Germany for 2.2 billion euro and launching a Singapore-based REIT focused on logistics and also industrial assets. So this move has monetized the undervalued assets by selling the depreciating warehouses into a fund. and into a new income stream. So the consensus target price is at 156.01, representing 35% upside and 97% of buy calls. So the chart is actually looking consolidating above its key support at 110 to 115 Hong Kong dollar, forming a potential collection zone. So if there's a decisive break above 120.9 Hong Kong dollar, so it will confirm a trend reversal in the near term. And last for Hong Kong, we have Tencent. So Tencent continues to invest aggressively, including the 1.16 billion investment in a re-owned gaming studio for 26.3% stake, strengthening its global gaming pipeline, and also partnering with the Thailand-based Bigcoup Group to provide cloud infrastructure for digital asset exchange, expanding its fintech and also cloud exposure in Southeast Asia. So the consensus price is at 762.79, implying about 20% upside and supported by 94% buy call. So looking at the chart on the top right, we can see the stock is actually rebounding after a brief pullback. So a sustained upside traction would form a U-shaped recovery and paving the way for next leg higher. Done for the dim sum. Now let's fly to US. So US, we have the first one, AMD. So AMD is scaling its AI exposure through their servers. So the server CPU business is expected to grow at least 50% in 2026 and the potential 15% price hike on their server chips. So the second half of 2026 could see a massive earnings breakout that isn't fully priced in yet. So also AMD partnered up with Tata Consultancy Services, the world's second largest IT services company, to accelerate enterprise AI adoption. So the target price is at 289.87, 30% upside. And technical wise, AMD is consolidating within a rectangular pattern, suggesting an imminent breakout in the near term while the broader long-term uptrend remains intact. Next, we have a special one, Exxon Enterprise, because of the recent happenings. So Exxon mode lies in the customer stickiness, with the net revenue retention at 124%, meaning their existing police departments and agency customers are actually spending more each year on Exxon's ecosystem. And also its ABW mini body camera is expected to enter commercial rollout by mid-2026. So target price at 807.37, 28% upside and 95% buy call. Technical wise, Exxon is rebounding from its prior low with a bounce off from the EMA lines, signaling a resurgence of buying interest and paving the way for next leg higher. Second of US stock picks, we have the Bank of America. So Bank of America benefits from the new fee income after allowing advisors to promote the Bitcoin ETFs. So this move Bank of America into a leadership position for the modern wealth management, potentially attracting younger and high net worth clients and increasing fee-based income from their digital asset management. Also on 9th January this year, it announced redeemed their $3 billion in senior notes and reducing its future interest expenses. So target price is at 62.2%, 18.6% upside. Technical, we see that following a 9-month uptrend, the stock has hit a new all-time high before gapping down yesterday. So despite this pullback, we see that the long-term uptrend still remains intact. Okay, next up we have the Broadcom, ABGO. So Broadcom benefits from long-term AI infrastructure demand. Its total backlog has surged to 162 billion from previously 110 billion. So with the AI contributing 73 billion, we expect to see delivery over the next 18 months with no worries of who to sell to. So the expansion into AI-enabled networking and also smart home solution extend its growth runway. So with that, the target price is set at 460.95, 35% upside, 95% buy call. Looking at the chart, Broadcom is consolidating at the upper range following its 9-month uptrend. So we see this as a healthy pullback ahead of a next leg higher in the near term. And last but not least, we have our favorite NVIDIA. So NVIDIA remains the anchor of the AI ecosystem. So approval to resume the H200 chip sales to China removes a major overhang, while the expansion into the AI self-driving tech with Mercedes-Benz broaden its revenue base beyond data center. So with all that, the target price stands at 257.1 with a 40% upside potential and a strong buy call of 93%. So NVIDIA is consolidating within a tight range as it waits for a clearer directional move. So we see that the long-term uptrend still remain intact with the stock holding above its key support level at 164.2 US dollar. And yep, that's all the 20 stock picks, and that will be all from me. I hope this session give you a clearer view of what to expect and where is the opportunity lies. Okay, now let's bring back Kenny and Park Leng for the Q&A session. And feel free to drop any question if you have any, and we'll answer them accordingly. Thank you.
Hello, yeah, feel free to drop in some questions. Easy ones lah, not the difficult ones.
Okay, sorry, I off my mic. Okay, Sharon asking on what's the status of withholding tax concession and when will we know the outcome? Okay, actually, I also want to know what is the outcome. Actually, the special tax withholding tax for Malaysian rate, right, has expired on 31st December. And this now is after 2 weeks. There's no announcement on yet. People are still waiting. But let's say, imagine for the worst case scenario, there is no renewal for Malaysian, right? There will be impact on the dividend yield because the income will be included in the income tax. Okay, that how much impact is also depend on what is your income level and your income tax level. For those who earn more than 100,000 a year, will get a higher impact of where you can be taxed 25 to 30%. But for those who are which annual income of lower than 100,000, I mean taxable income, lower than 100,000, will have a lower tax, meaning that your yield they are still reduced in the yield, but not as much as the higher income bracket. I think there will be the impact is about 50 to 100 basis point. I think for the low income group, we'll see about 50 basis point reduce in the dividend yield, and higher income could go to about 100 basis point. Let's say if your dividend yield is 5.5%, a high high tax bracket, right? For of the REIT holders, I think will get a 1% drop in the yield from 5.5% to 4.5%. It's something like that. Yeah. Okay. Is that clear? Maybe we look at other questions.
Okay, let's take this question from Cass. Cass, stock pick CBH Engineering and Capital A. Yeah, my stock pick included CBHB because of their strong fundamental and also Q&Q achieve higher earnings. So looking at the chart, let me share screen. Give me a second. Can see my screen? Can see, right? Okay. So looking at the chart, it has broke out its listing to date high at 57 cents few sessions ago. So we believe CBHB will experience a mild pullback as we can see currently. So for the looking forward, we believe there might be a pullback and the support levels, first support will be set at 57 followed by 53. As long as the stock pull back and hold strong above its key support at 48, then we see that CBHB will continue to continue its uptrend and bullish bias in the near term. For Capital A, okay, so after I think this shoot up because of the privatization news, and we have a small collecting here, and yesterday it shoot up and break out its, can say it's a multi-year high since 2020. So we can see that looking ahead for Capital A, we might see a correction as well after a strong shoot up. But looking ahead, we believe the long term, the uptrend still remain intact given that positive news and also positive sign of the management. Okay, that's for these two. Okay, let's see what else. For Cass, your GHS lucky draw price at Rakuten. Okay, maybe you can come and collect and tell our salesperson so he can give it to you, your price. You can contact our customer service, yeah, for your price collection.
CT Lee asking, is IGM shareholder should accept offer from Sunway? Yes, because the premium given is I think quite good. But as for Sunway's shareholders, I think the recommendation is because the current share price has already reached the target. It will the growth for Sunway perhaps will be from the following the merger, if this merger is successful, IGM, because IGM has quite a number of high margin projects, and Sunway's PE is trading about 20 to 30 times, and IGM valuation is around 19 to 20 times, which means it is worth for Sunway to issue shares at 30 times PE to buy IJM's 19 to 80 times PE. Yeah.
And we have the next one, Lynette Lim, asking opinion on Gamuda. So Gamuda is one of our blue chip stock picks. So I've mentioned just now that Gamuda has quite a strong outstanding order book. Currently stood at 39.8 billion ringgit, and their target for this year is achieving 50 billion ringgit. So looks likely it will achieve, as currently is standing at 39.8, right? So strong earnings visibility, and also winning quite a lot of projects from Australia, data center, and also some other projects. So the target price is now at 6 ringgit and 13 cent based on 22 times PE. So have a quick look at the chart. So for Gamuda, we see that recently, after hitting its new all-time high at around August last year at 5 ringgit and 80 cent, it experienced a quite huge of pullback and breaking few times of its support level. But we believe Gamuda, given their strong fundamental, this could consider as a good collection period, as currently is considered good entry at a lower price. So as long as it holds above this key support at 4 ringgit 23 cent, we believe the uptrend still remain intact, and also the rebound is likely to confirm soon. Okay. Okay, let's continue with the question. We have someone asking on Paradigm REIT. Okay, have a quick look at the chart. Paradigm REIT, newly listed last year around June. So we can see that Paradigm REIT has a profit taking after its listing. It is we see as normal, a healthy pullback. So after 2 times of testing its support level at 92.5 cent, we believe this will act as a strong key support for Paradigm REIT. And after a rebound, we believe that Paradigm REIT is likely to break up its immediate resistance very soon at 1 ringgit, currently at 99 cent. A break above would drive the Paradigm REIT to next leg higher, given a better momentum with the resurgence of buying interest. So currently, this level will act as a accumulation zone to break its immediate resistance in the near term. So if it breaks above, we believe the next resistance to test is at 1 ringgit and 3 cent. If it didn't break above, then there might be this will act as a strong resistance, and it will pull back at this level. Okay, let's see if tomorrow and the next few sessions, if it can break this strong resistance level.
Okay, on this Paradigm REIT, its yield, right? Is projected, is the target yield is around 7%. So if this withholding tax thing is still not yet resolved, the impact to the dividend to the yield dividend yield is about around 1%. So you will get about around 6% yield after tax.
Okay, let's take the next question, asking on Guanchong. Will it recover before mid-2026? Guanchong. Looking the long term, it is actually experiencing 1-year downtrending, and looking nearer, we see a round pattern. Possibly, hopefully, there will be a rebound, but looking long-term wise and also the EMA indicators, it doesn't show a bullish signal yet, still quite bearish, given that the stock still trading above the EMA lines and also meeting its 2-year low, nearing its 2-year low. So if Guangzhou didn't manage to hold strong above its immediate support at 72.5 cents, the next support level will be at 66. For the fundamental wise, actually there's quite a huge upside potential given the consensus target price of 1 ringgit and 36 cents, which is 79% upside. So given the high buy call and also good upside, let's see if Guangzhou will rebound soon. If it breaks above this immediate resistance at 88 cents, then we might believe the trend is returning. Then they will end their downtrending and possibly a trend reversal for next leg higher in the near term. That's for Guangzhou.
Okay, for Guangzhou, right, on the fundamental side, I think investors are actually concerned on the falling of the earnings. But what the market expectation is, Guangzhou's profit for 2026 will be around 260 million, which is quite significant as compared to 184 million in FY25. Yeah.
Okay. Next question asking outlook for United Healthcare. I can give you a technical look. United Healthcare. What's the ticker? Oh, I think should be this one. Okay, so is it this one? Let me check. Okay. So for United Healthcare, looking at the long-term wise, it's actually trading at the lower range of the trend since 2020. So it breaks below its key support level at 443 level and currently moving sideways within a range of 234 to 380 and currently forming a higher support level at 305. So looking forward, if United Health managed to hold strong above this level, this will act as a key support and possibly trading within this range, 300. To change the trend pattern, a decisive break above its immediate resistance at 3 ringgit, $380 will be significant for a trend reversal confirmation. So looking in the near term, likely there will be just a sideways movement.
Stephen Patrick is asking Tenaga technical analysis.
Stephen Patrick. Wait, where's the... Oh, yeah. Okay. For Tenaga. Okay, so looking at Tenaga, long-term wise, currently trading in the upper range of its trend within... Give me a minute. Give me a second. Trading within is recent low at 12 ringgit and 48 and the upper range of 15 ringgit and 22 cents. So after it breaks below its key support at 13 ringgit around last year December, it holds strong above 12 ringgit and 50 cents and rebounded quite strongly and currently tested its immediate resistance set is today's close, 13 ringgit and 92 cent. So we can see that after a consecutive white candlestick forming, we have a bullish flag pattern breakout a few sessions ago. This indicates a healthy pullback and also currently gathering strength for next leg higher. So looking in the near term, next few candlestick, if there is a breakout at the immediate resistance 13 ringgit and 92 cent, then we believe Tenaga Nasional will continue its uptrend. And the next immediate resistance to test will be at 14 and 50 cent. 14 ringgit and 50 cent. Looking at technical indicator, we can see that during end of December, around nearing Christmas time, there is a bullish crossover. This also signals a bullish bias, which we see that looking in the near term and looking forward, there is a positive sign for next leg higher. Okay, that's for the technical. I think due to time limit, we will take one last question. We will take from Yongjie, SMIC and Hong Kong Exchange. So for SMIC, which one? SMIC. Give me a second. 981 SMIC. Okay, SMIC. Okay, looking in the long-term wise is actually trending in a long-term uptrend starting 2024. This is a positive sign. So we can see that after it breaks its all-time high, all-time high during this August last year at $59.80, it created a new all-time high at $93.20. So this considered as a healthy pullback after hitting its all-time high with 4 months of rally. So we deem this as a healthy pullback. Looking in the near term, we believe that SMIC will be trading within the key support above its key support 59.80 cent and 93.20 cent. So the nearest support level will be found at $70.70, followed by 59.80 cent. So the immediate resistance to test will be at 83.60 cent. If it tested this and break above, then we might see in the near term it will test its new all-time high at 93.20 cent. Given the technical setup also quite bullish, a newly formed bullish crossover during 5th January also formed. So the stock is closing above the EMA lines. This shows positive signals looking forward. And next on Hong Kong Exchange Index. Okay. So looking at Hang Seng Index, give me a second. So looking at Hang Seng Index, we can see it's currently trading in a 2-year uptrending. And recent few months, we see a consolidating between 25,088 to upper range 27 and 392. So we believe Hang Seng Index will test its immediate resistance very soon, looking at today closing at 26 and 923. So if it tested and break above, then we might see Hang Seng Index to continue its uptrending and to achieve its multi-year high again in the near term. Okay.
Prepare for dim sum, yeah.
Yeah. Okay, I think that's all for today. Let me
Yeah.
stop sharing the
It's
screen.
all for today. Okay. Thank you for the attention, everyone. So that's all for today. On our sharing market outlook. So good night, and hopefully you guys can sleep well. All right. So bye bye.
Thank you,
Good night,
everyone.
everyone.
Bye.
Have a pleasant night and a weekend. Bye.
Bye bye.